Ladies and gentlemen, good day and welcome to Isgec Engineering Company Earnings Conference Call hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ranjit Shivaram. Thank you, and over to you, sir.
Thanks, Bilal. Good afternoon, all. On behalf of ICICI Securities, I'm pleased to invite you all for the 4th FY21 results conference call of Isgec Heavy Engineering. Management is represented by Mr. Aditya Puri, Managing Director, Mr. S.K. Khurana, Executive Director and Company Secretary, and Mr. Kishore Chatnani, the CFO. We will have an initial presentation by Mr. Aditya Puri on the results and the outlook, and we'll follow up with Q&A. Mr. Puri, you can start with your initial dialogue.
Thank you, Ranjit. Good afternoon, everyone, and thank you for joining us on our earnings conference call. I hope that you and your loved ones are all well and safe. This is our 5th investor conference call, and I look forward to a fruitful interaction. We have also uploaded our presentation on BSc, NSC, and our website earlier today. Many of you are familiar with our business. For the benefit of the new investors and analysts joining for the first time, I will give a brief introduction about our business. We are a diversified heavy engineering company engaged in manufacturing and project businesses. We manufacture process plant equipment, presses, and iron and steel casting. We execute turnkey projects for setting up boilers, power plants, air pollution control equipment, sugar plants, distilleries, factories, and bulk material handling facilities. We've also developed strength in construction. We address the requirements of a wide spectrum of industries, mainly power, fertilizer, sugar and distillery, oil and gas, automobile components, steel, cement, chemicals, railways and defense. Our presence across multiple industries and geographies helps us spread any sectoral or geographical risk. Let me now talk about our consolidated financial results for the quarter. The total consolidated revenue for Q4 of FY 2021 was at rupees 1,628 crores, which is up 4% compared to rupees 1,560 crores for Q4 of FY 20. For the full year of FY 2021, our consolidated revenue is at rupees 5,477 crores, and it's declined by about 7% compared to rupees 5,915 crores in FY 20. The consolidated EBITDA for Q4 of FY21 is at rupees 131 crores, which is 86% higher compared to rupees 71 crores for Q4 of 2020. For the full year FY 2021, our consolidated EBITDA is at rupees 507 crores, that is 42% higher compared to rupees 357 crores for FY 20. The EBITDA margin improved by 228 basis points, driven by savings in employee costs, reduced legal expenses, reduction in travel expenses due to the lockdown, and increased efficiency, and because of higher sales and profitability in our subsidiary companies. The consolidated profit after tax for Q4 of 2021 is rupees 69 crores as compared to rupees 13 crores for Q4 of FY 20. This is an increase of 445% compared to last year. For the full year of FY 21, our consolidated profit after tax is 3 crores, which is 70% higher than the profit after tax of rupees 149 crores for the full year of FY 20. I will now talk about the order booking. The consolidated order booking for the full year FY21 is at rupees 4,860 crores, which is higher by 27% compared to the previous year. The orders in hand as on 31st March 2021 are rupees 6,765 crores against rupees 6,935 crores the previous year. The order booking position continues to be satisfactory. Of our consolidated order book, about 80% is for the project business and 20% for the product business. The order book includes rupees 969 crores worth of export orders, which is about 14%. Order booking for Isgec Hitachi is also good. It has 430 orders, rupees 433 crores of orders as on 31st March 2021. During FY21, the overall demand trends were encouraging after the lockdown was lifted. Many new orders were booked from sectors such as railways, power, which includes boilers, air pollution control equipment, waste to energy, water, process industry, construction, fertilizers, cement, refineries, steel, sugar, ethanol plants, chemicals, food, oil and gas, renewables, automotive, aeronautics, refractory, mining, soda ash, paper, and tool and die. We've also increased our focus on booking more orders for operation and maintenance of power plants and distilleries, and we've booked good orders there. With the onslaught of the second wave of COVID-19, since the last few months, work was again adversely affected. Factories were running normally until the third week of April 2021, and in spite of there being many COVID-positive cases, there was no shortage of labor. However, there was a shortfall in production because of non-availability of oxygen and argon gas. The availability of oxygen and argon gas has normalized from 1st June 2021. In the EPC project businesses, we had to keep our offices in Noida, Pune, and Chennai closed for 6 to 8 weeks in the current quarter, and employees work from home. Offices have reopened in June with 20 to 50% attendance being permitted on a rotational basis. All project sites were operational, but considering the fear and panic all around, retention of existing manpower of contractors became a challenge. Some difficulties were also experienced in resource mobilization, such as tying up with testing agencies and procuring tools and cranes. Supervision of erection and commissioning was also adversely affected due to some of the engineers being COVID positive. The working at project sites has improved in June 2021 and is now near normal. The turnover and profitability for the current year will therefore be less. We've given special emphasis on vaccination and also organized some camps for vaccination at our offices and factories. 97% of the eligible manpower, our employees and contractor workers, have received at least one dose. Q1 FY 2022 has been good in terms of new orders finalization. We booked orders of worth over rupees 1,500 crores, though in some the advances are yet to be received. This includes some export orders, though export order finalization will take some time to pick up after the COVID situation reduces. As you may be aware, commodity prices, especially steel, have gone up steeply. Prices for steel plates, structures, and TMT bars have gone up 16 to 18% since 1st January 2021. This may have adverse impact on our cost and profitability. About 48% of our order book, that is PSU customers, has price variation clauses, and the price increase can be passed on to the customer. For the rest of the order book, we have fixed price contracts from customers, but keep contingency and margin on costs. These will not be enough to cover the cost increase. Steel has moderated in the recent weeks, which is good. Regarding the Cavite biofuels ethanol project in the Philippines, we've decided to start construction and complete the plant. We think it's a good business and will be profitable to run, though we will keep the option to sell it when it's complete. In general, Isgec continues to be optimistic about our overall positioning in the market, and with our presence in multiple segments and geographies, robust balance sheet, state-of-the-art infra and manufacturing capabilities, technology partnerships, and right quality of people, we will continue to focus on increasing our shareholder wealth, strengthen financial metrics, and serve the community and people at large. Thank you. Hello, could you hear me?
Yes, sir. Should we open the line for Q&A session?
Yeah.
Sure. Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask any question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may please press star and 2. Participants are requested to use handset while asking a question. To ask a question, you may please press star and one. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Viraj Mehta from Equirus PMS. Please go ahead.
Yeah, hello, sir.
Hello.
Sir, just wanted to understand the kind of order booking that we are hearing from the ethanol side. How much of the new orders that you talked about this quarter and last quarter, if you can give a rough understanding, how much comes from more profitable segments like ethanol and presses for autos?
Yeah. So the one area where the order book is really depressed is the press business for the autos. Although in the last month or so we have got some orders, but it's still not as good as the other sectors. So I would not say that there is a very high percentage of new orders from there. And ethanol also, we've been selective in booking orders. We are going to commission our own distillery soon. So we haven't booked any very significant orders for the distillery sector as yet. This 1,500 crores is basically from other sectors.
Got it. And sir, just if you can quantify, you said that there is going to be margin pressure because of like almost 60% of our projects do not have pass-through clause. If you can quantify in terms of whether the hit will be how much? Will it be like 100 basis points, 200?
We are still in the process of quantifying that because steel has been very volatile and recently it's again started showing some signs of coming down. In fact, it has come down a little bit. And it's expected to come down in July further. So we will take a call soon, but there could be a slight hit from what we had projected.
Understood. And sir, last question was on capital allocation. If we look at our policy of taking orders even on lower advances because it doesn't make sense the interest that we pay, will we continue with that policy for government projects?
So government orders, we cannot dictate the payment terms. So we will have to build up the interest cost in as a cost to us, and then see the margin, and on that basis decide to take the order or not. But it's not that we will stop taking government orders.
Understood. And sir, has the competition in the FGD segment reduced? Because what we are hearing is probably a year back the number of bidders and today the number of bidders have reduced by almost half.
Right.
Is that correct?
It has reduced. I'm not sure whether it's half, but it certainly has reduced.
So has the margin, the quality of work and the margin in that business, is it expected to be better than what it was last year and the year before?
Yes.
Including the recent Orissa order that we won?
Yes.
Okay. Thank you, sir, and best of luck.
Thank you.
Thank you very much. Anyone who wishes to ask any question may please press star and one. The next question is from the line of Siddharth from Equitas Investment. Please go ahead.
Hi, good afternoon, Mr. Puri.
Good afternoon.
And heartiest congratulations, Mr. Chatnani, on your appointment to the board. And I must, and congratulations. So my question is regarding our EPC business. Right, I look at our numbers. We do nearly 1,000 crores of revenues every quarter, and our EBIT margins are just 4.5% on that business. And if I look at for our manufacturing business, I would believe that we would work on advances. So the return on capital employed for that particular business would come out to be very low. At 4.5% EBIT margins, and for the kind of products that we have and for the kind of capabilities that we have, it is one of the lowest margins that I see within the entire EPC space.
Yes, so I do agree with you over there that the margins are low and are lower than the products business. But as I told you in the previous calls, that we've gone into new sectors and we are now improving on our efficiency, and we've come up to a learning curve. So margins should improve, barring external shocks like these. Margins would be better, barring these external shocks such as steel prices going up or other commodity, copper, nickel, aluminium going up. So these shocks, I think everybody has to bear. But we are pretty confident that our efficiency is going up and margins would go up given other things are equal.
So, Mr. Puri, have we tried benchmarking ourselves to our peers in terms of margins on the EPC front? Because at no point in time in the last 3, 4, 5 years have our margins in the EPC segment gone. EBIT margins are in excess of 5%. Yeah, and for the kind of capabilities that we have, the skill sets that we have, typically when we look at your competitors, most of them would be edging closer to 9 to 10% as far as EBIT margins are concerned.
Right. So we have benchmarked ourselves. We've seen what sort of work they are doing, what sort of work we are doing, where we need to catch up, and we are certainly making an effort towards that. And I think, and I'm sure that it has actually improved. Had these shocks not been there, it would have been even better. But we are still striving for better margins. Your point is well taken.
Okay, right. And I must congratulate you, Mr. Puri, again on appointing Mr. Chatnani and Mr. Gulati on the board. It's very nice to see professionals getting appointed on the board.
Thank you. Thank you for that. Thank you.
Thank you very much. A reminder to the participant, to ask a question, you may please press star and 1. The next question is from the line of Dushant Mishra from Sage One. Please go ahead.
Hi, good afternoon. I just wanted to know, so one of the previous participants mentioned that there's a different margin profile from each project segment that we cater to. Could you tell me which ones are sort of higher margin businesses? Because I would imagine some of them, like sugar, what you mentioned, or will have entail a higher margin as compared to something like an FGD system. Which ones are the?
No, I think what he was referring to is projects versus products. So EPC versus manufacturing, basically. So manufacturing has a much higher margin than the project than EPC project business has.
But within EPC, different industries we cater to are pretty much along a similar margin profile. Is that so?
They are similar margins. It depends on order to order, basically. It depends on order to order. There is no generalization to say that these orders would be at lower margins or these would be at higher margins. Yes, of course, we know that when we take the order, but it's as of now we are not. We're taking the orders on the basis of the margin, and there is no trend to say that this particular segment will give you a lower margin and this will give you a higher margin. It depends upon the competition for that particular tender or order.
Understood. Okay. And on the bid book side, do we know what our bid book stands for? What kind of projects have we bid for that we haven't really received anything yet?
Have we? Sorry, what was your question on the bid?
What is the size of our bid book?
It's good. We bid for a lot of projects, and as of now, we seem to be in a good position as far as what we think our potential order booking in the near future would be.
Understood. And what is the mobilization advantage we get from private guys, from private orders that we do?
Private guys, we normally get between 5 and 10%. Sometimes 15, but mostly 5 to 10%.
And for government orders, there's no advances, right?
So government orders, there are two things. Many government orders do offer advances, but we do not many times take the advances because they are interest bearing.
Understood. Okay. Got it. And going forward on the private side, would we want more orders to be with a pass-through clause price escalations that we've seen, or will we keep them at a constant price, fixed price contract only?
So that's not in our hands. It's the way the private sector orders. So it's for us to decide whether to take the order or not. And most private sector orders are without the pass-through clause. So we really don't have a choice in that.
Got it. Thank you.
Thank you very much. The next question is from the line of Hitesh Chheda from Lucky Investment Managers. Please go ahead.
Sir, for the flat backlog that we have versus last year, what kind of revenue growth do you envisage in the forthcoming year? And my second question, pardon my lesser understanding. So when in the consolidated, we have a division called as sugar. Is it sugar machinery there, or it is sugar business there?
Sugar, the manufacturer of sugar.
So from the capital allocation standpoint of view, are we looking forward to do anything on the sugar business in terms of any unlocking? Because we have 1,000 crore type debt on the balance sheet, and our ROCEs are also less. So from that point of view, any thought plan process that we have?
No, not as yet. Not as yet.
Okay. So what will we be doing to improve the ROCEs in the business, overall company ROCEs, which are at about less than 15% for the last 3-4 years? How would we improve the ROCEs in the business?
Basically, looking at improved profitability, and with these FGD businesses and all, whenever they finish in the next 8 to 12 months, the NTPC types, a lot of money will come in, which is, I wouldn't say it's stuck there, it's according to the payment terms, but capital is deployed over there.
And on my first question on the flat backlog and what kind of revenue growth or revenues do you see for FY22?
So we certainly see we are impacted with the effects of COVID, but we certainly see a very healthy year this year, and it should not be in any case worse than the year which has gone by. We are pretty bullish about the fact that it will be better, but we have to see whether a third wave comes or what happens.
So you're seeing growth in revenue, but with a slightly lower margin.
I'm not saying that. I'm saying that it could be a revenue. We don't expect a dip in revenue. We expect a growth in revenue, but we are cautious of the fact that there may be another prolonged lockdown that may have an impact.
Okay, sir. On the bid book side and on the visibility, since you cater to a lot of process industries and sectors, from the initial comment which mentioned power, fertilizer, sugar, steel, cement, and a whole lot of sectors. So from the bid book perspective, what kind of movement or bid books or orders, tenders that you are seeing vis-a-vis what you would have seen versus the last 2-3 year activity on the capex side of your customers? Some thoughts or light there would be very useful.
So we are generally seeing an increased level of business activity in spite of the COVID. We are seeing that, but it is more on the government side. The private sector is also investing now. There is no doubt about it, but it is still being more cautious.
So from the bid book perspective, there is no.
The bid book is good.
So bid book, is it moving higher or it is still where it was?
No, it's moving higher. It is moving higher.
Okay. Based on your experience, and that's my last question, do you see, so if you look at the larger capexes in the system, it has largely been flat for so many years. And for us also, if you look at the engineering business, it's been in a certain range for, let's say, about 7-8 years that I see. Based on your experience, do you see that the capital cycle or the capex cycle by your clients is going to strengthen, and there will be probably a long runway for us in terms of growth and in terms of size of business, as we have been largely flat for the last 5-6 years or 7 years?
I think it's because we have gone into a few new areas that we will see that we are not short of orders and the order book remains healthy and grows. But as regards the capex cycle, as the West is seeing as it's opening up, the economies are very robust over there. So if we can get over this this COVID phase, people are allowed to travel, foreign countries accept us. Let me use that word. They accept us. I certainly think that India and our company will grow fast. But even if it doesn't, we do not see any shortage of orders in our company, barring maybe a few months here and there. But on a secular trend and in the short run, we are comfortably placed and hope that we will be comfortably placed in the future.
Okay. Thank you very much. I'll come back if I have more questions. Thank you.
Thank you.
Thank you. The next question is from the line of Deepak from Birla Mutual Fund. Please go ahead.
Hello, sir. Thank you. Yeah, thank you very much for giving me the opportunity. Am I audible?
Yeah, thank you. Thank you.
Yeah, sir, I have a couple of questions. First is regarding this ethanol opportunity. I just wanted to understand your presence in the ethanol business, and do you have any plans to go into two or second or third generation ethanol production, and what kind of opportunity you are seeing in this business, and do you have anything in your order book from ethanol as such? Number one. And number two is what is so you have delivered somewhere around 8% margin in this year, if you look at FY21. So do you have further scope of improvement from here on? What is your target, and from where you are targeting to improve your margin?
Yeah. So as far as your question on ethanol is concerned, I'm not very clear about what your question was. Was it about our own ethanol plant coming up, or was it different? What was your question on that? I'm sorry, I did not get that.
So correct me if I'm wrong, sir, but you have you set up distilleries or not?
Right.
You set up distilleries for customers also, and there is a lot of talk and lot of legislation in this regard by the government.
2G. Okay, so we are not currently into the second generation of ethanol. It is yet to prove its cost effectiveness. So we are not into 2G ethanol. And regarding your question about margin improvement, yes, there is.
So, and sir, in 1G, what kind of opportunity you have in 1G?
1G, we will book orders as and when we get orders at a decent price. We will book orders. There is opportunity, and in the next few months, we feel that a number of ethanol plants will be decided.
Okay.
Right. And secondly, as regards your margin improvement question, yes, there is scope for margin improvement. The external shocks, steel commodity shocks have been there. The slowdown during COVID times has been there. But Barring these external shocks, there is scope for margin improvement, and we are working towards that.
Okay. So what is your bid margin in this EPC project? If you are delivering 4.5% margin, what is the kind of your bid margin in this project?
We are not facing too many variations. So bid margin would also be would have been this previously, but it has improved now. The bid margin has improved now. So when these projects are executed, we could see improved margins in the coming years.
So I just wanted to know, sir, that this 4.5%, the actual execution of margin, is it there is a lot of cost overrun? You are bidding higher, or that you are bidding at this level only?
No, I'm saying that there are no too many cost overruns. There are no too many cost overruns. There will be no too many surprises. No.
Okay. Thank you.
Thank you very much. Anyone who wishes to ask any question, please press star and 1. The next question is from Digant Haria from GreenEdge Wealth. Please go ahead.
Yeah, hi sir. I have 3 questions. So the first question is that see, our order book has been in the range of 6,000 to 7,000 crores for a few years now, despite adding a lot of new verticals, a lot of new technology partnerships. So let's say that if the capex cycle really picks up in the next 2-3 years, do we as a company have the capability to execute orders worth, say, 10,000 crores, or that will require more capacity build-up, or we are ready for that if it comes?
We are not ready for it as of now, but doing 10,000 crores over a period of another 2 years or 2.5 years, we can easily build up our capability. Over 2 years, we can easily build up our capability to do 10,000 crores. Manufacturing, yes, takes a little more time, but otherwise we can build up our capability.
Okay, thanks for that. So my second question is, again, on this sugar and ethanol thing, that, the ethanol policy the government has announced, and, there is a lot of talk that, ethanol production has to triple and, or, maybe quadruple over the next few years. And, we are present only in one of the 3 technologies which are there. So for the other 2 technologies, which is the 2G and 3G, are we planning to do some sort of technology tie-ups with somebody who knows that, or, because it may be a very big opportunity, and if we are not ready at the right time, maybe we will not be able to capture that. So any thoughts?
We are talking to 1 or 2 companies, but we ourselves are not very convinced about the economics of 2G and 3G as yet.
Okay, sir. So maybe when you see a right time that maybe the scale has become so large that it becomes profitable, we may jump into it.
Exactly.
Okay, sir. Okay, that's the second question. So the third question which I had is, you just responded to the previous participant that in EPC business, our bid margins and the actual margins that we make are between 4 to 5%. So is it, we are bidding at the levels of 4 to 5% because are we new in some of these areas, or is it just because we want to keep our plants and workers busy that we are taking orders even on low margins and surviving this low capex era of the last 5 years? How should we look at this?
Okay, so let me just answer your question to say that we for our EPC business we manufacture very little. So it is not that we and for most of them we manufacture nothing. For more than 60% of them we manufacture nothing. So I would so we are not taking this business to keep our manufacturing facilities busy. It's the nature of competition. It's some of these businesses we've entered for the first time, and the learning curve has been good. And as I said, the recent orders, the margins have also improved because we have learned. We have learned. So this is a deliberate move to get into these sectors, even with a lower margin. And our learning process in the execution has also helped us now to improve on further execution.
Okay, sir. So just for some sectors where we have already a lot of experience, would the EPC margins in those segments be a little better, say 6%?
They're beginning to, yes, they're beginning to improve. Some of the recent orders, they are at better margins.
Okay, sir. So great to know that. Thank you so much and wish you all the best.
Thank you.
So if I may ask one more question, sorry, the operator if I'm still online, I would like to ask one more question.
Please go ahead, Mr. Haria.
Yeah. So, sir, you just mentioned that, the foreign countries not accepting Indian travelers. So does it become really difficult for us to get orders and, to monitor the execution? And if that thing, say, goes away in the next 12 months, that, we can travel and roam around freely like before COVID, would the foreign business also get a big fill-up?
Yes, it would. It definitely would. It has been very difficult, actually, but we have not faltered. It has been difficult finishing the projects overseas and sort of remotely commissioning them from here, giving them remote support from here. A lot of that has happened, but we managed that successfully. But for new orders, for meeting new clients, that confidence has to be there. First of all, there is this perception overseas that there is a lot of COVID in India. So, if we give an Indian company an order, it will get delayed. Then they always say that COVID is not a cause for force majeure, which we do not accept. Because it is a cause for force majeure. So, and they want to meet you face to face. So I think once the COVID situation improves and we are able to travel, or they are able to come here, we have had lots of clients who in the first wave said that, we in the next 2 months we'll be here in India to see you, and nobody is turned up. Now also people are still saying, July, August will be there. Let's see what happens.
Thank you. We have a next question from the line of Ankit from Bamboo Capital. Please go ahead.
Yeah, thanks for the opportunity. Sir, on the machine manufacturing side, we have seen significant improvement in margins to almost 13.5% in the quarter, and even for the full year, our margins have been around 10.5%. So, and this is despite the significant increase in commodity prices over the past 6 months or so. So, what was the reason for such significant improvement in margins, and how do you see this margin spanning out over FY22 and FY23?
So one reason for the good margins was that in manufacturing, if you are able to get more out of your facilities, you could stretch your capital investments more. The returns are much more than in the project business. So we had good order booking, good turnover, a lot of control on efficiencies, and our factory locations were not as even if they were impacted by COVID, we could control the situation much better because we've been there for a long time. We know the area, not like sites which are spread all over and in remote locations. So it was a good order book, efficiencies in operations, which actually led to this improvement.
Because if I look at it, last year also we did close to 600 crore of revenue from this segment, and our margins are almost half of what we did in this current year. So it was somewhere around 5.23%, and this year we've almost doubled our margin. So just wanted to.
So we worked very efficiently on manufacturing, and we have also sort of we are doing marginal investments to increase our capability at a few places, increase our capacity, at a few places, because we've reached a situation where we are actually having to refuse orders.
Sure. So how do you see margins panning out in the machinery segments over the next 2-3 years?
This should be good. This quarter is not going to be good because of COVID and because of lack of oxygen. A lot of our facilities could actually not function. But even for the year, they should be good.
So can we expect 10-11 kind of margins, or we can even touch 14% kind of margins?
That's very fine-tuning. It's very too much fine-tuning happening over here. But yes, 10-11%, yes, hopefully, yes.
Sure, sir. Thank you so much. And sir, on the orders inflow side, last 2-3 years we have seen significant slowdown, and over the past few months, bearing this COVID impact, we are seeing and we are hearing of significant pickup in private as well as government cases. So how do you see the order inflow over the next 2 years and FY22 and FY23, and hopefully factoring in there is no third wave in the country?
No, I think the order booking should be good. As we've seen in our first quarter also, order booking should continue to remain robust.
Sure. And so on a larger, from a strategic point of view, over the past few years, we have tended more towards, government orders, and we have entered a lot of new areas as well in railways and other industries. And now we are also seeing some pickups in private capex as well from industries such as cement, steel, etc., sugar, etc. So over the next few years, how do you see the mix changing between public and between government and private orders in our order book, and how will that be impacting our working capital requirements? Because over the past 2-3 years, even if we factor in this, even if we remove the impact of the Philippines refinery, our working capital requirements have increased significantly. So how do you see this mix panning out over the next 2-3 years and its impact on our working capital requirements?
So, it's difficult to say, but we will not probably go beyond what we are in the government sector today. But if there are good opportunities over there, we will not even fall drastically from this mix if the opportunities in the government sector are good. We may not go beyond this mix, but it's not that the government will fall also will come down to low 2 digits, 10%, 20%. I don't see that happening also.
Sure. And
because there is a lot of trust from the government on the expenditure side, investment to expenditure side. So one cannot ignore that.
Sure. And so the working capital cycle should not worsen from this, is what you are also trying to say.
Yeah.
And so, last question from mine, given our scale in EPC of around 4,000 crores and on equipment side of around 1,500-1,600 crores, as a company, have we built capabilities and capacities to take the EPC turnover to, let's say, 6,000-7,000 crore and machine manufacturing to 2,000-2,500 crore over the next 3-4 years, or we are still building that up?
No, so if we wanted, we could have booked another very many more orders. But we ourselves are being selective, and we do not want, like I think one of the previous participants was saying, we could build capabilities of going to 10,000 crores in 2 years, but we will be selective with the orders and then gradually increase. So both on the manufacturing and the project side, we will gradually increase and not suddenly say that, tomorrow we are going to do 10,000 crores. That's not the aim. The aim is to grow, but to grow steadily and to grow in a way that we can deliver efficiently.
Thank you very much. In the interest of time and fairness to all participants, please restrict your question to 2 per participant. The next question is from the line of Avdut Joshi from Newberry Capital. Please go ahead. Mr. Joshi, please go ahead with your question.
Yeah, good afternoon. Thanks for the opportunity. 2 questions, sir. Hello?
Yeah, please.
Yeah. Sir, fortunately we have a very long history of our company. So just wanted your assessment as to where are we on the, capital cycle as such. Do you see that we are at the beginning of a cycle somewhere what our company had done from 2004 to 2007 onwards, or can you relate? Are there some signals that you are, monitoring which indicates a broader level capex recovery of something of that sort? And my second
of the economy in the economy.
Yeah.
And
the economy also, and also of the company in the sense what the how the order booking was there from 2004 to 2007. Do you envisage that kind of a scenario? Is that a possibility, or?
Order booking, see, I am very optimistic about the future. And it's not, I'm an optimistic person per se, but it's just not based on that. It's based on certain things that one reads and hears. So India will probably, we are probably seeing the beginning of the capital cycle going up. And our company is well placed to take advantage of that. So, barring external factors, I think I would say that we are in the right business, and things should improve in terms of order booking and everything else.
Okay. And so my second question is, any status update of the Philippines plant? In terms of sale or?
Yeah. So we are going to complete the Philippines plant, and because we got a study done also, a formal study done, it's now very clear that it's going to be very profitable to run the plant. But once we've completed it and the right opportunity comes, we might even sell it. But we are going to complete and run the plant. We're going to complete the plant and start running it.
Okay. And there are no impending litigations or any prolonging litigations on that plant now? From now onwards, right?
No.
Okay. All right.
Thank you very much. The next question is from the line of A.M. Lodha from Sanmati Consultant. Please go ahead.
Hello.
Hello.
Sir, congratulations on that set of numbers, sir.
Thank you.
I have 2 questions, sir. One, one is about our own distillery of 110 kiloliters. Whether that has commenced the production, sir?
No, we'll finish it by July, and then some government approvals are required. So in the next few months, the commercial production will start.
Okay, what will be the cost of that distillery, sir?
Pardon? Sorry.
Cost of project.
Can you just give the numbers?
Cost of project of the distillery.
Kishore? We'll just get you the numbers. Yeah. What's your second question?
Second question is regarding again, the Philippines unit, the Philippines subsidiary. When it will commence the production, sir?
Maybe 12 months from now.
12 months from now?
Yeah.
How much work is still pending, sir?
About 50% of the erection, 40% of the erection work is there. The supplies are 97% there.
question is from the line of Sunil Kothari from Unique PMS. Please go ahead. Mr. Kothari, please go ahead with your question.
Hello. Are you getting my voice?
Yes, yes.
So, just a minute. Hello. Yes.
Yeah.
Sir, my question is, looking at your so many years of experience on EPC products and engineering sector, which of the area internally you would like to improve upon, where you feel you require to maybe do better than what currently we are doing? Which are the area where you see lack of some technological gaps? Would you like to talk about the internal improvement which you may be planning or you think you should do?
No, so I cannot talk about the internal improvements in detail. I cannot talk about it over there, but we are, if I may say, we are continuously striving to perform better, whether it's in terms of delivery, it's in terms of cost, delivery times, cost, cycle times. We are striving, we are making good progress over there. And as far as technology is concerned, we are quite alive. We have a department which keeps looking at it. We have some people who keep looking at the new trends coming in the economy and where we should be looking for potential partners. And as in as and when anything fructifies, we inform everybody about it. So I can't talk to you about any concrete technology right now, but I can only tell you that we are alive to it and in the market for some technologies. But it's with time that these things, as and when something happens, I'll tell you.
True.
But as of now, I'm not seeing in the work that we are doing right now, I'm not seeing a huge technology gap. Yes, if we want to get into other areas, we would require technology.
Great. And sir, last question is on basically our manufacturing products gives us roughly 30% of revenue between 27 28. Do you see over the next 2-3 years the major shift happening towards manufacturing of product segment, because you are very competitive in terms of manufacturing and products, and it is giving better margin and better return. So do you see any change in those ratios?
So what I would put it this way, that we are with marginal investments expanding our manufacturing setup in certain lines of businesses. So what the future brings in terms of the mix between projects and between EPC projects and manufacturing, I cannot say right now. But yes, we are certainly in certain niche areas of ours expanding our manufacturing base.
Okay. Thanks a lot. Thank you very much.
Thank you. The next question is from the line of Janil Mehta from Omkara Capital. Please go ahead.
Hello?
What's the name?
Yeah.
Sir, did the manufacturing margin increase due to increase in demand for presses from North American market?
North American market presses are no longer manufactured by us. They are manufactured in the Canadian setup.
Yeah. On consolidated basis, I am saying.
Yeah, so we've seen a very good order booking from the North American thing in the Canadian subsidiary in the last few months.
Okay.
So with those economies opening up, the order booking has been very good.
And also I want to ask, sir, what was the reason for drastic fall in margin for sugar business in this quarter, both on year-on-year terms and quarter-on-quarter terms?
Sugar business year-on-year, Yeah. Kishore?
I think it's a function of the quantity of sugar sold. So sugar is valued at lower of cost to market price, and you realize the margin as and when the sugar is sold. So in the previous quarter, the quantity of sugar sold, including exports, was high, and this quarter we had exhausted the export quota. So this quarter we were selling only the domestic market, so the quantity was less, and that changes the margin. I mean that changes the turnover and margin for you.
Okay.
More or less selling last year quota.
Okay. And sir, for our ethanol distillery, are we going to transfer sugar production into that segment for ethanol production on a large scale?
Yes. So let me put it to you this way: the plant has the capability of using a B-heavy molasses and producing ethanol. And as of now, yes, we will be using some B-heavy ethanol to produce. B-heavy molasses to produce ethanol, which will reduce sugar production. But this decision will be taken almost on a spot basis, depending upon the sugar prices at that time and the sugar recoveries at that time.
Okay.
But yes, the plant has the capability, and we see, in all probability, we will be doing that. The extent of which will be variable depending upon the relative pricing at that point in time.
Sure. Thank you very much. In the interest of time and fairness to all participants, please restrict your question to one per participant. The next question is from the line of Paras Edinwala from Capital Portfolio. Please go ahead.
Yeah. I had actually several questions, but I'll try and prioritize them. I was just looking at your business segments and the segments that the customer segments as well. Looks like you are into several things, whole host of things, and you touch almost each segment of the economy. Do you think there is any scope for improving your focus on a few segments as far as your competencies are concerned? And also from the customer segment, do you think you can rationalize that segment and focus on a few rather than on so many?
So some of that scope, your question is very valid, but some of that scope comes from the fact that some of our products may not be very differentiated, but can be used by a number of segments. So, for instance, we manufacture boilers. Now, over the years, we've learned the technology of burning various types of fuels and different sorts of technology. But it's not that one particular industry per se will use only one sort of boiler. So it is that boilers are used in almost all process industries. So all process industries do become our customers, and we have to do nothing very special on the product designing or manufacturing from one, but it doesn't depend so much on which industry it's going to. Because our end product is steam, for instance, in boilers, right? So we are not dependent on the process of the other the end industry. But yes, having said that, this also provides us a sort of it hedges our risks. So if one industry is down, we get orders from the other. But your question is valid, and over a period of time, there may be some industries where we, some segments where we say, okay, this is low margin business, let's not get into it.
Okay, I'll just squeeze in one a very short question. I'm cognizant of the time problem. In the last 5 years, your top line growth has been around CAG in about 4%, and the bottom line maybe about 5 to 6%. Do you think over the next 5 years this could improve both in the top line and the bottom line? And if yes,
yeah, it could. Yeah, it could, because we are now into new areas. Investments are happening in the economy, and we believe that we have a greater share of the market than we had previously.
Okay. All right. Thank you so much.
Thank you very much. The next question is from the line of Viraj Mehta from Equirus PMS. Please go ahead.
Yes, sir. All of my questions have been answered. Thank you.
Thank you very much. The next question is from the line of Digant Haria from GreenEdge Wealth. Please go ahead.
So my question is on Philippines. What will be the total investment once we complete, and start running the plant in Philippines? And the second question is that, once you get buyers, because we understand COVID would make it difficult for buyers to come and evaluate. Like, do you think the value of the plant is still very much intact, and there is a possibility of selling it without any loss of money or?
Yes. Yes. To answer your second question, yes.
Okay, sir. And the first question, what will be the max total capital invested?
We will let you know. We will let you know. Kishore,
we are working on that.
Right, so while you work out that number, we said that we'll run the plant, but is it more likely we'll run the plant because till we find a reasonable buyer because we think it's a good plant, we will run the plant and not just let it go for a loss or something like that. Is that the strategy?
No. The plant itself, the running of the plant itself is looks to be highly profitable.
Right, I understand, sir, but it is not our original objective to run that plant, and it was because of the unfortunate turn of events that.
I know.
Do it. Yeah. So, but if given a choice between running and selling, if we find a good seller, we would like to sell it, right?
If we find a good seller and we get a price which is going to give us a very, very big profit, yes, we might sell it.
Oh.
And we will certainly be looking for a seller because ultimately we do not want to concentrate our energies in the Philippines. Obviously, there is some division of energies over there, but it's not that we are running it for the sake of just running it. We've done a thorough study to see the payback, the profitability, and everything.
Right. Great, sir. Thanks. Only at the end of the call, if you can provide me those numbers, the total max investment that will go in the plant.
Okay.
That's it from my side. So, thanks.
Thank you very much. We'll take our last question from the line of Pritesh Chheda from Lucky Investment Manager. Please go ahead.
Yes, sir. One question. Between the standalone debt and the Concall debt, I see a Concall at about, let's say, 900 to 1,000 crore and standalone at about, let's say, 100 or 150 crores, whatever be the number. So the difference in debt, if you could give the bridge, why the Concall debt is high and where it stands?
Yeah. Kishore?
The debt is largely in three companies. Firstly, the sugar company, because the season was in full swing as of March, and they have a huge amount of sugar. So there is debt there, working capital debt for sugar. Besides that, there is.
Quantify it as well, sir?
I don't have the numbers readily. You will soon see our balance sheet on the website. Yes, or I can separately send you if you.
Okay, so that is sugar company then.
No, and also the ethanol plant under construction. So that there is a loan of about 97 crores as of 31st of March, term loan from HDFC Bank for the ethanol plant under construction. That is one. Second is the Philippines company. That has a debt of about 280 crores from the Land Bank of Philippines. The third is Isgec Hitachi Zosun. That has a debt of about 140 crores as of 31st of March. And lastly, Eagle Press.
Isgec Hitachi is how much?
About 140 crores.
Okay.
And lastly, Eagle Press has a debt of about 70 crores.
And you said that ethanol plant has a debt of 90 crores from HDFC Bank. That is what, plant in India?
That is the plant being set up in Saraswati Sugar Mill.
Okay. Okay. So, and if you could quantify, is this the number correct that you have 1,000 crore debt on console and 175 crore on standalone? Is this number correct or?
You can check it from the balance sheet. I can also check it for you.
Whatever I could interpret from the balance sheet is what I've taken. Console, long-term plus short-term, but these days balance sheets are made weird with those other financial liability and then there is other liability.
Total debt is about 880 crores.
And that is console and standalone?
Standalone, give me a second.
Sir, with the new accounting method, it's very difficult even to interpret the balance sheet without asking the management actually. Sorry for that, sir.
No, that's okay.
The old accounting methods were good.
Standalone debt is 173 crores.
So I got that right. Okay, understood, sir. Thank you very much.
Thank you very much. Due to the time constraint, that was the last question. I would now like to hand the conference over to Mr. Ranjit Shivaram.
I thank the management for taking time out to answer the questions. I thank all the participants for their insightful questions. Sir, do you want to make any closing remarks?
Yeah, thank you very much. Thank you everybody for attending the conference. Stay safe. Thank you.
Okay, yeah, thanks.
Thank you, Participant, on behalf of ICICI Securities. That was the call. Thank you for joining us, and you may now disconnect your lines.